We've got 100 companies that will be presenting today. We have 5 panel sessions where we're going to talk about a variety of subjects. But today we're going to kick off this day with a very special keynote from David Weild. David is former Vice Chairman of NASDAQ. He is Chairman of Weild Co, and he's recognized as the father of the Jobs Act. I have had the honor of having some really fascinating discussions with David today. He has some very interesting perspectives, has a history of interest in the healthcare and medtech industry, and is very involved. And it's just a treat to have him here today. So thank you for being here. Let's dive in, and if we have some time at the end, hopefully we can ask some questions. If we don't have time at the end, I encourage you to find David, and hopefully he'll stick around for the balance of the event. Thank you.
I can't tell you how impressed I am with the job that the LSI people and Scott are doing with this conference. It's just absolutely terrific to see, coming out of COVID, how many people have shown up. And so if I could, for the staff of LSI, just have a brief round of applause. I ran, many years ago, I was running a top 10 investment bank. I was running corporate finance at Prudential Securities, which is now part of Wells Fargo. And I was the management person or the line person in the investment bank working on the tech conference we did at the Grand Hyatt every year. And I can tell you how much work goes into the logistics and pulling something like this off. And this is about as classy an event as I've seen. Happy St. Paddy's Day. Any of you that know me know that I'm first and foremost a patriot. I believe deeply in this country and the direction that we need to go, that capital formation, entrepreneurship, and diversity are the things. And diversity not just in terms of ethnicities, but points of view, that we all kind of come together, and if we can add capital and entrepreneurial instincts to things, we're going to solve amazing challenges. And that's everything from climate change to healthcare. I studied molecular genetics, actually fulfilled my undergraduate requirements with graduate level coursework in molecular genetics, wrote for Genetic Engineering News as a kid, saw Genentech go public in 1980. Stock went from 30 to 80 something dollars in the first day of trading, and I was just seeing the convergence of capital and innovation. I met a gentleman in Europe who funded the first contract in genetic engineering for the cloning of somatostatin, which was a small molecule. And I've been an advocate for what everybody in this community is doing for pretty much my whole professional career. And I look at it as being a bit of a blessing that I get to do this. The things that I've gotten to do, I spoke at the G20 in Istanbul not that long ago. And when I was Vice Chairman of NASDAQ, I got to be the complaint department for Steve Jobs. I used to talk to him every month, and that was an experience and a half. But everything from all the life sciences companies, 85–90% of the life sciences companies were on the NASDAQ stock market. That's one of the reasons why I went there. So Weild Co is building the first decentralized investment bank, major bracket. We've now got professionals in 21 states and 4 countries, and we want to be in all 50 states. The idea is that there's a demographic shift going on, and we've got a lot of talent, people that are connected. Wall Street's a little bit ageist, and so by aggregating those people and getting them to collaborate remotely and deliver better results, we'll be able to make ourselves an outside contribution to the economy. We plan to bring it up to 1,000 professionals over the next 5 years, and fill in that void that occurred in the middle market and sort of that death valley of finance to a large degree. So this is something that we're going to continue to work on. People wonder, what's missing in the market today? And what's missing is really a great aftermarket support model for micro-cap companies. They're asymmetrical order book securities, which means there's a big seller and no buyer, and you need intermediaries. And in the inestimable wisdom of some of people at the SEC going back in the 1990s, we decided that we were going to collapse trading spreads and commissions and go all electronic, which actually cut the economic model out of from the research analysts, the sales professionals that were needed to go out and create offsetting buyers for sellers. And so we started to lose institutional interest in microcap securities. And recently, I mean, what I said here is that, you know, it's the lack of aftermarket profitability, stupid, that's been hurting small IPO activity. It's the kind of missing link of what we need to fix on the public policy front. We wrote a paper, it's highlighted in yellow at the bottom, that was published for the Organization of Economic Cooperation and Development. And in that paper, there's an econometrics model that predicts the number of small initial public offerings, that's sub-$500 million market cap companies, weighted for GDP. We looked at 26 different countries. And 70% of what predicts small IPO activity is profitability in the aftermarket, okay? You know, I got on this path because I had a number of experiences. I was running strategy at Prudential Securities for banking, research, sales, and trading. And, you know, we had to move people out of making markets in small cap companies when we went to all electronic markets and penny increments and trading stocks and started to collapse commissions. I had confirmatory discussions with Dan Case, who was at the time president of Hambrecht and Quist, Steve Case's brother, who was the founder of AOL, and he was a good friend of mine. He's actually exactly the same age. Unfortunately, he passed away in his early 40s of a brain tumor, but a wonderful human being. I was presiding over what I call the bubble rubble in the wake of the internet bubble while I was vice chairman of NASDAQ. We were delisting smaller companies, and so we saw the support going out of these stocks. And so it was you know, unlike economists who like to put models together and predict things, you know, I was living with the consequences of these changes, and so I had a kind of a catbird seat of you know, connecting the dots of what was actually undermining small cap companies. So this is a chart. These are all in some of the old papers that we wrote that led to the Jobs Act. And on the far left is 1991. The far right takes it up to 2009. It's actually started to improve, but the dark blue is IPOs under 50 million in size. The orange tranche is large IPOs, larger than 50 million in size. And you can see that the small IPOs sort of went the way of the dodo bird, starting they really start to collapse in 97, 98. What was that? Well, there were a couple of things that were implemented in 97 and 98. 99, 97 was the new water handling rules. I'm missing in 1998 on this chart something called Reg ATS, which was the dawn of electronic markets. And that's really the culprit, should be in that slide. But you were doing 539 IPOs a year, which, you know, fast forward, you're doing 126. That really kind of puts a cap on our productivity as a nation, you know, particularly in the social impact industries. Now, this one is just a small $25 million IPO subset, and you can see how they collapsed. And the reason that's significant for this community is if you went back and you looked at small IPOs, medical device industry dominated small IPOs. It was mostly what financed the medical device industry, because it was single product companies for the most part, was $25 million IPOs. So what we did to our capital markets actually had an outsized impact on this particular industry. And so, you know, one of the things that we always talk about, pendulums swinging, they don't swing. They get shoved back in the opposite direction because people like us, if you remember the movie Network, we stick our heads out the window and we say, I'm mad as hell and I'm not going to take it any longer. So for 3 years, I went out and spoke 30 times a year to anybody that would listen, and had the fortune of being in front of some people like John White, who is a partner at Cravath, Swaine & Moore, happens to be married to Mary Jo White, who was the SEC commissioner, chairman. And from all of my musings, one day Mary Shapiro, who was SEC chair, was called up to Capitol Hill, and somebody at the SEC had seen me present and thought I had something to say and asked me to go substitute for her in the Washington American Bar Association Securities Regulation Luncheon. I gave that speech. So we got a lot of people that were interested, including the SEC, on board as a result of some of these random walks. Now, this is the sort of same data again, but it's just a mountain chart, so small versus large IPOs. So it's obviously very dramatic. If you, as I mentioned before, the need for a functioning IPO market in medical devices is more important than any other industry, just because of the nature of what you guys do. And so I want to ask everybody at the end of this, if you want to be an ally and you want some help, we're going to take another run at it. We're going to add some economics, hopefully, back into the IPO market for micro-cap stocks. We got very close in the last Congress under Trump. It was the 2018 Congress on an act that was called the Jobs and Investor Confidence Act of 2018. It passed the House of Representatives 406-4. It included a new form of stock exchange called a venture exchange that rescinded the requirement for companies under $1 billion to be subject to the rules that eviscerated the aftermarket economics. Essentially what it did to kind of get research back in there, institutional investors back in there, retail investors. And so I'm going to quietly stack that up. It went through the House 406-4. Trump administration supported it on their blog. And it failed because he got into shutting down the government over the wall, and that pushed the legislation into the next calendar. And the Senate was supposed to tack it onto the appropriations bill and pass it into law. But of course, that year, the Senate appropriations bill never happened. So we're getting close. There's obviously bipartisan appetite. I think if I have a broad coalition of people that are in the medical device industry, we can ultimately crack the back of this one, and I think we can, get back to the glory days of capital formation in medical devices. And that's probably the single most profound thing that we as a community can do to drive up social impact in our country and ultimately U.S. competitiveness. Okay? It has profound implications. This is the classic throw the pebble in the lake and set off a ripple. It will move through the economy. It will drive upward mobility. It will do some just amazing things in terms of curing diseases, improving the quality of health care. It's the single most important thing that we can do. Now, this was a slide that was used in the House Financial Services Committee subcommittee on capital markets and government-sponsored enterprises that really catalyzed. You can see the date there, 2010. The Jobs Act was passed on April 5th. It finally signed into law 2012. And I was testifying this day, and the House pulled this slide in particular, and I remember them saying to me, one of the congressmen, "Mr. Weild, which one is China?" I said, this is the number of publicly listed companies in the growth index to when they changed market structure to all electronic. That's the significance of this. And I said, "Sir, China's at the top." He said, "Mr. Weild, where's the United States in this chart?" "Sir, we're at the bottom." He said, "Which country would you prefer to be?" He said, "Don't answer that question." It's profound. We went from 9,000 publicly listed operating companies to 5,000. Okay? Think about that. That's kind of Armageddon from an economics perspective. And, I want to see us, get back up to 10,000. We're growing it. We're growing the base again because of things like Regulation A+, I'll talk about in a second. But, if you look at the domino effect, these are all these little red companies. These were back in 1994. There were 162 investment banks that acted as a book runner on a small initial public offering. Again, less than 50 million in size. And if you fast forward it brought it all the way down to 34. Okay, this is a paper called "The U.S. Need for Venture Exchanges," published by us in 2015. You can search that up on the net. But all those red firms are gone. Okay, that's your ecosystem. I mentioned, where we are in terms of our business. We got named to the Inc. 5000, and this past year we're growing pretty rapidly, which gives me also a lot of confidence. Look, I'll go back for a second, and I just want to make the point that if we were successful getting legislation passed and we were in no states, we're now in 21, 22 states, and we're growing. We'll be in all 50 states. We're relevant. We're creating jobs in those states. We think we can be really, really, really powerful in Congress, kind of holding their hand and moving them forward in terms of where we need to go. The Jobs Act was really 6 bills wrapped into one, okay? It was an omnibus bill, and there were 4 major titles. There's a title here that actually increases the number of shareholders from 500 to 2,000. As a guy with a science background, I didn't have much knowledge about political science. I confess to have taken no poli-sci courses at my alma mater, Wesleyan University in Middletown, Connecticut. But I'm a pretty good pattern recognition machine. And so just by showing up, we got a lot of feedback from a lot of congressmen and senators and honed our craft and sort of started to feed them what they were looking for. And we're able to articulate arguments about why what we were trying to do was good for poor people and well-to-do people and the United States, and why it would contribute revenue ultimately to the U.S. Treasury. So the first title, which was the emerging growth title, basically made it more cost-effective, gave people a safe harbor from the onerous provisions of Sarbanes-Oxley 404 if they were sub $1 billion in revenue. It also allowed them to actually pre-market transactions and do crossovers. I'm going to show you in the life sciences industry the profound effect that had instantaneously this is a biotechnology industry organization data. I had a paper called A Wake-Up Call for America where we suggested that they repeal the prohibition against general solicitation and private placements. That turned into 506C, which I know has been very impactful. Reg CF started out at $5 million. It got carved back because of the concern about raising money from non-accredited investors down to $1 million. It was sponsored by Patrick McHenry in the House of Representatives. And when the Jobs Act got sent back from the Senate to the House for an up or down vote, it was whittled all the way down to $1 million. Effective March 15, 2021, it was taken back up to the original $5 million. So it's now something that I think is really interesting for startup capital. Title IV, which is the Regulation A+, mini IPO public offering, but really it's a kind of an open canvas to do different forms of finance, and you're going to see that thing explode. That's my projection in terms of size. It's a much lower cost way of filing for public money, and it gives you now $75 million over 12 months. And there's some discussion about taking that up even higher, as much as $150 million. We'll see what happens. This is from the report to Congress on Reg A, which is cited in the deck. And Scott, you can make the deck available to people if you want with the live links, and it just hopefully drive the knowledge base along a little bit. But you can see that we're growing in terms of the numbers of the proceeds of Regulation A+. This is from the government report. And they profess, the government says that, and this is 2 of their highlights in the report, among Regulation A offerings, Tier 2 accounted for most of the issuer activities, successful offerings and growth in proceeds. That's the one that gives you the exemption from state blue sky regulation. It requires you to report. I don't think you want to get into filing with the states unless you're doing a very narrow localized offering, which is Tier 1. There's a different reporting regime than a traditional public offering. Under Reg A, it's very, very skinny down. It's actually biannual, not quarterly reporting. You do something along the lines of an 8K to update material information, but it's all slimmed down. It's much more cost effective. So I think it's really an interesting arrow in the quiver for people that need to raise capital. For the minority of Regulation A issuers that had a secondary trading market for their securities, this is important, stock returns after that offering were positively skewed, meaning they're working. We'll talk about why they may be working in some instances. This is Reg CF portals. This is a new ecosystem, folks. I mean, it's People are out there experimenting. The SEC is always, every head of the division of corporation finance that I've ever talked to is always surprised at how slow it is for these things to develop when you do rule changes, because you've got there's a large community in the United States that needs to be educated, and meanwhile you have lots of attorneys that are warning people against doing the new thing because they don't want their clients to jump into the water and be as penguins at the edge of an ice floe and risk being eaten by a shark. There's 80 firms that are active. There's a couple that are inactive. And these are just the active ones right now. And by the way, if you look at Title I of the Jobs Act and what it actually did, this is the Biotechnology Industry Organization's slide. Okay? Wow. Look at that in terms of social impact. We tripled the amount of IPO activity, largely because we're putting technical leads and credentializing IPOs through crossover buyers like the OrbiMeds and the Deerfields and the Perceptives of the world in that industry. And nobody can do due diligence in a heavy IP industry, newsflash, medical devices, without somebody, it's a marker on the cap table that says somebody kicked the tires and knows what they're doing. So that technical lead is so important to see show up. And once you can do that, when we took the gloves off, we allowed people effectively to pre-market deals without having to go to jail. In the old days, you'd queer the offering and you'd have to delay it, right? Very simple fix with incredibly profound consequences. I had this conversation specifically with Meredith Cross, who was the head of the division of corporation finance, and I said, hey Meredith, she said, what do you think about, you're putting in these testing, the waters provisions into Reg A Plus and other provisions, what do you think about this quiet period that we have leading up to an offering prior to an IPO? And I said, in my inimitable sort of no filters fashion, I have a kid that's even worse than I am, I said, I think it's really stupid. We have these sophisticated institutions that under the law we believe caveat emptor. They know more than the bankers do and the companies many times, and yet we're trying to protect them from what? Heavy IP. And we're now expecting that in this very heavy intellectual property industry, we are going to allow sophisticated institutions only 1 hour in a one-on-one setting on the IPO roadshow to do their due diligence. It just doesn't work. So what happens is if the stock trades down, people really don't know what it's worth. They haven't been able to get up the curve. They don't have the courage of their convictions because nobody's been really able to kick the tires. Stock trades down, everybody blows out of it, and it just exacerbates the valuation for the company. That was essentially the pattern. So, obviously this is transformative. My favorite one, and this is a little bit of an eye chart there, but it's right down in the lower left-hand corner, that little 18 approved drugs. Okay? Wow. Now, I don't know that we can take full credit for it, but we contributed to this, and that's social impact. I love that. So these are crossover investors. This is from PitchBook, and this was as of a March 8th, 2021 report. Look at OrbiMed, right? Vertically integrated healthcare. I think they're here, are they, Scott? And, they're doing a lot of the God's work of investment banking, effectively, or investing by lending their name, and it's a crossover investor. They'll go into the market and get an average cost basis in the stock at a lower pre-IPO price, help to defend it in the aftermarket. We need to really develop that whole methodology in the life sciences area at an earlier, not life science, medical device profession, at an earlier and earlier stage. You go down the list, T. Rowe Price, Deerfield, there we go, another one vertically integrated in healthcare. Perceptive Advisors, right? And so you got Fidelity on the list. Fidelity, 95 crossover investments. Okay, so this has really structurally changed the way that we're doing finance in this country, and it's given you guys more options, and options have value. This is sort of interesting, 506C, it's, and the people are just getting in, used to kind of how do we market securities in the New World Order. But if you look at the third column there, $66.3 billion, according to the SEC, of capital was raised in 2019. Again, that comes right from a paper we wrote called A Wake-Up Call for America, asking for the repeal of the prohibition against general solicitation. It's sort of funny sometimes, You have to question securities laws. Do they make any sense? I mean, why did we care who we were talking to? We care about who invests in the company if you want to restrict it to accredited investors, right? So, we should be able to shout from the mountaintops and advertise and not worry about querying our capital raising process because it interferes with our ability to commercialize businesses too, to plain talk, to get on TV, whatever the case might be. And we already, under the law, are not protecting accredited investors. All we have to do is make sure that the person that shows up on the cap table is accredited. And it's so obvious, but for some reason, somewhere along the lines, the train got off the tracks, and we ended up with a market where we could not generally solicit private placements. This one's going to grow. So let's talk about Regulation A+, and a formula for success. Again, likelihood that sharks are in the water has been grossly exaggerated. Everybody's worried about lawsuits and class action suits, and there just hasn't been a lot. And this answers the riddle of why, the SEC passes regulations, and a year later, this is a true story, I'm looking at these regulations and saying, why can't I do an overnight equity offering? I'm running equity capital markets at Prudential Securities. Why can't I do an equity offering off of a Form S-3 shelf registration, kitchen sink? Because meanwhile, hedge funds have exploded in size. Guys are doing fully marketed offerings. The stocks are getting banged lower and lower and lower while you're on the road by hedge funds. I said, I want to take away the risk and just do an overnight equity offering, announce it at the close. So I talked to my general counsel at Prudential Securities, Lee Spencer. Lee was a former head of the Division of Corporation Finance, Gibson, Dunn and Crutcher partner. And he said, well, I don't know, but the person that wrote those rules was Linda Quinn at the SEC. She took over for me after I left the SEC. So he sets up a meeting. I go in and talk to Linda, and Linda says, this is a year after the rule's been passed. He says, it's funny you should ask, because what you're describing is exactly why we wrote the rule. And it's a year later and nobody's used it. So we did an overnight equity offer. We ran everybody around on pagers, show you how long ago this was. And we hit the company's target price, which was north of $30 a share. And so we said, in the middle of the afternoon, we walked across the research analyst. We tracked down the company. They were on a sales incentive trip down in Mexico. You can't make this stuff up. And the telephone connections at the time are terrible. This is pre-cell phones or the early days of cell phones. And we get them to agree to do the deal. We tell the entire institutional and retail sales force that we're going to announce a deal at 4 o'clock in the afternoon after the market closes. Men and women, man your battle stations. We announce the deal. We do $125 million overnight off of this shelf registration with no risk, okay? And we actually oversold it so that we would have a short position to stabilize the transaction and be able to defend the stock in the aftermarket. And that night we put the print up, and I get a call from David Miller, who's running equity syndicate at Goldman Sachs. And he says to me, quote, Weild, what the F was that you just did? And for those of you who don't know, this is where all your ATMs, at the market offerings, registered directs, accelerated book builds, in equity capital formation, that's where all that stuff really kind of started, all off of Form S-3 shelf registrations back in the 90s. So we've got a convergence going on. This is going to create a revolution in how we finance. And some of it's really, really fascinating. So we've got Regulation A+, which is lower cost. And most of these, so if you think about how to do this, the first thing you want to do is that validation stage, which is you need a corporate strategic or venture capitalist, or hopefully more than one, show up on a cap table. You raise the valuation in the market, so they're getting a great deal by lending their name to the technical due diligence. Okay, now we go out and we market it. Now look at Affinity Marketing, very different from retail broker intermediated marketing. And by the way, CoreConnex is, which is, I'm in the interest of fair disclosure, I'm an advisor to Oscar Joffrey, and they're doing some amazing things that are going to help drive this. Affinity Marketing, meaning that you get a firm that can take all of this online social media, direct marketing technology, and profile people based on their interests. So we start to create a universe of what I call passionists, people that are, whether they're doctors, they're people that have been affected by the disease, that basically, this is an emotional appeal. You've got your technical box checked through the validation phase with the corporate strategic investor and Abbott and Medtronic. I mean, look, lend your names, folks. You know, you can be very, very helpful to driving up the rate of capital formation here. 3M, you know, as a venture capitalist, I know I'm going to be meeting with tomorrow morning. And that validation, you now turn online marketing to retail into something that is much more the kind of emotional appeal. It's that matching. It's the doctors. It's how what is it going to do for patients, that people that have that particular disease that you're trying to treat. Very short attention spans, very different kind of marketing. You blow it out. The interesting thing is these shareholder bases are a lot stickier than broker intermediated shareholder bases in the retail. And the reason is that brokers want to get the cash back into the account. So they flip the stocks, okay? Here, they believe in what you're doing. So you've got a much better longer-term shareholder base. You also should budget something in the aftermarket to continue to sustain that, because there is no economics in aftermarket support any longer. Remember what we were saying at the beginning? So you need to budget for that, and hopefully over time we'll change the market structure so that there's embedded economics that a marketer can actually, through a broker-dealer, can actually enjoy, and we'll get back to good old times, but only instead of being broker intermediated, it'll be tech marketing mediated through a broker-dealer. And then finally, the interesting thing about blockchain, because everybody's concerned about an exit. How am I going to get the proxies in with this highly fragmented database? And if you're on the blockchain, you know everybody. You know 100% of the investors. You can communicate with them, okay? I mean, it's a tracking system, for want of a better description. So you can get the votes in on the sale, okay? So this convergence is going to transform finance in this country for the better. And what I would tell you is, you know, get out there, experiment, you know, get up the learning curve, interview the heck out of people that are doing affinity marketing, and look at the return you're getting in terms of shareholder base. But don't shy away from it, and don't think that there are sharks in the water. You know, there's a way to do this stuff, and it's going to be very transformative, I think, particularly for the medical device, medtech industry. So again, technical lead on the cap table, tier 2 regulation, A+ offering, recipe for success, targeted affinity marketing, direct to retail, attract doctors, affected families, concise emotional appeal, not technical, passionists, physicians, prime the future commercial market, right? Okay, may or may not trade. You don't have to trade these things, okay? You can restrict them by contract, okay? So think about that. If you look at what venture capitalists like to do, you know, you make a benchmark, they move the valuation up. You make another benchmark, you move the valuation up. You could do the same thing here, but broaden it to retail investors and restrict this trading of the stock until you're at the point where you think you've got enough critical mass and support so that this thing can actually trade really well. Okay, so this is a really interesting blank canvas that we can work through to customize transactions depending on the company's needs. And then finally, you may or may not list on a public, on a major stock exchange at some point. And let me just point out that in the aftermarket, there is no blue sky exemption unless you trade on a national stock exchange. And the challenge if you trade on NASDAQ or the New York is then you become a fully reporting company in the aftermarket. So the costs will go up, okay? So there's a time and a place to do everything. Maybe at some point we'll come up with some exchanges, maybe Core Connects at some point that has an exchange exemption and a national exchange listing and can confer upon a company a national exchange, a blue sky exemption in the aftermarket, but it's not there yet. Policy. I'm going to ask everybody in this room to do me a favor. We're fighting for American competitiveness. Okay? We're looking to up our collective impact and create a legacy for our kids. It's not about me, and it's not about guys that are my age group. It's what's the toolkit that you're leaving for your kids so that this country can sustain its competitiveness. You know, we've got a country on the other side of the globe with 1 billion more people than we have. We have another one that's disrupting Europe right now. And so if you believe in freedom and diversity and innovation, all the things that America fundamentally is good at, then you want the economic infrastructure, the capital markets rule book that will allow us to be the envy of capital markets across the globe. You know, when I was Vice Chairman of NASDAQ, President Jiang Zemin of China said that NASDAQ was the crown jewel of the US economy. And this was in the 1990s because we were birthing entire new industries because of our enlightened capital market structure, which we got away from, okay? So I think it's the job of everybody in this room to contribute to making sure that we bring it back, we shore it up, and we go out and enable as many qualified people to go out and solve problems, cure disease, improve patient care, hopefully at the same time ultimately drive down the cost of medicine as a percentage of GDP, and at least go to our graves thinking that we did something that mattered. And I know people that come to this industry generally are about more than just making money, you know, which is the brilliant thing about the medical device industry, and that's why I'm so proud to be invited to speak here, Scott, so thank you. I'm going to take some questions now, if I can, but I do want to get from all of you that's interested in being an ally and sort of staying involved, a business card. Just tell me, you know, if you stick them in my hand, you know, we'll circle back to you, and we're going to create a big group of allies to, you know, to make sure that we bring the message to Washington again, and we get ourselves to the, you know, the next level and continue forward progress with access to capital for the entrepreneurial growth community.
Good morning.
Good morning.
I'm Manny Villafana.
Hi, Manny.
I'd like to thank you for the work that you have done. And I may be one of your first customers, per se. Our company has recently announced that we are going to do a Reg A. Okay. The one question that haunts me, and particularly from the people who support what we're doing, is how does an investor that participates in the Reg A find liquidity? At what point does that individual who may have put in 10, 20, 100,000, whatever he puts in or she puts in, when does that person have a liquidity event? Like an IPO would typically do that, but from what I'm hearing here, do we ever need an IPO if you have this? So how do you answer an investor that's interested? Manny, I love what you're doing, the work that you're doing. Okay, you're doing good. Now let's make it well. How do you answer the investor about liquidity?
It's a great question, Manny, and by the way, congratulations on being recognized for lifetime achievement here.
Thank you. Thank you.
I know you're a bit of a rock star in this community. I think it's no different than, you know, any other IPO route. This can be a bona fide IPO. There have actually been deal structures in Regulation A that have traded directly, been listed directly on NASDAQ as an initial public offering. So again, it's canvas. So the question to some degree is, how do you structure it, and when is it appropriate, and what guidance do you give investors? Just like anybody in a private investment has no liquidity, you know, but you're going to talk to them ultimately about what's your plan, what's your trajectory for an exit. And I think that there's a bunch of things. You can do a full-blown, you know, initial public. You can restrict the trading and march it up and build value, and so and grow that value, and then do a subsequent listing. It can be done with a capital raise or not with a capital raise, and actually actively trade it. You can list a Regulation A+ offering and have it trade immediately. The question is whether or not it's wise, and will it be actively supported? And so there's also one of the things that sometimes obviates the need for instantaneous liquidity is security structure, and sometimes people offer securities that give people the potential for a percentage of EBITDA. We're seeing this in the token markets now. Tokens as securities, which are sort of like crypto, but for securities, if you will, and debt-oriented securities, things that are like convertible securities that then, you're at least getting something, distributed to you as you go along. But if you're pre-revenue, that doesn't really work particularly well. So what I would say is, just march it up and tell people, this is what our ultimate aspiration is in terms of equity, in terms of exit. If it's exclusive sale, M&A exit, have that discussion. If it's potentially getting to critical mass so that it can sustain itself as a public company. Keep in mind, though, that IPOs are generally not exit events for investors, right? Because the underwriters will typically limit the amount of secondary shares, insider shares that can be sold on those offerings. Interestingly, Regulation A+ does allow a certain percentage of secondary sellers, okay? But no investor coming in wants to see a management or an insider bailout. There are also other things structurally you can do, and look, I don't want to get overly technical, but there was a fund that was done by the Shares Post, which is trading private market securities unicorns in Silicon Valley, founded by a gentleman named Greg Brugger. And they set up a fund called the Shares Post 100, which was, because these are all illiquid pre-public companies, and it's called an interval fund. And there's a quarterly tender there, so that people do have the potential to get up to 5% liquidity on a quarterly tender. And I think that those kinds of structures may ultimately come into these markets to help answer folks. If it's restricted from trading, at least there's the specter of some liquidity that's effectively managed by the management team, and there's excess capital that's reserved effectively for these tenders, and it may help to answer that question. But it's something, if you want to brainstorm a little bit, offline, we can spend some time doing that. I need to know more specifically about, the stage of development where you are, and you want to plot a course that looks out, just like you would, here are my benchmarks, here are my venture rounds at higher levels. I need to do the same. You need to do the same thing for where are your benchmarks, where you're going to be in terms of the arc of the life of the company, and mirror that with the financing events and the liquidity events that go along with it. It's what's the 5 to 10 year plan, I think, is really ultimately the question that every company needs to answer. Yes, sir.
We got time for, go ahead.
Yeah, I wanted to, first of all, thank you for passing the Jobs Act. I wouldn't be in this game if it wasn't for Reg D 506C. But my question is, I'd like to hear your thoughts on the proliferation of SPACs in this field and how the SEC is addressing it.
Yeah, so SPACs are actually more of a symptom of a market that is not working well for exits at the top end now, right? Because what happened was, we turned all of our retail brokers that were marketing stocks into asset gatherers and allocators into exchange-traded funds. So that ecosystem of marketing talent that supported companies no longer exists. If you go to the bulge bracket Wall Street firms, the Morgan Stanleys and the Goldmans and the Barclays, you're going to find Credit Suisse, you're going to find that the average institutional equity sales force is covering 60 institutions. And what they're doing is they're playing for a traditional underwritten equity offering, the only return that's left to them, the only alpha that they can generate to large institutional accounts is systematically underpricing deals to their top 20 institutional commission payers that represent 60% of their commissions on average. And then shake them down when they get a 40% pop in the price, shake those accounts down for more commissions. Now, it's not illegal because what they're saying to them is, we're going to reward with allocations our biggest commission-paying customers. But that actually has created a divergence in the alignment of interest between issuers and the investment banks, the large investment banks. So as a consequence, it's opened up a window for innovation with SPACs. And we've seen this proliferation of SPACs as an alternative because it's faster to market. You're not taking a lot of the prep risk. I think this stuff is here to stay unless we bring back a better functioning public market for corporate issuers, right? Because the need is there. And, but I like to say it's a symptom of a bigger disease, which is a public stock market that doesn't work effectively to support the interests of corporate issuers. And one of the things when I start framing arguments to get people at the SEC and Congress to understand, the SEC has actually done something historically, which is an oversimplification of their investment. They have a three-part requirement in their mission. One is capital formation, which I think they fail miserably at. The second is investor protection, which I'm going to explain how they fail miserably at that. And then the third one is market integrity. The investor protection one is an interesting thing because if you define investors as investors that are coming into the company that are new, and those are the only investors that they've generally protected, and you ignore the incumbent investors that take most of the risk to get you there to begin with, who arguably are the most important investors, then this market structure has thrown the most important investors under the bus, okay? And I think that once we start shining a light on the need to protect that group of investors as vigilantly as new investors, I think that it will completely reframe the discussion and take the SEC to a point where they become much more effective stewards of capital formation over the long run. Hope that helped. Okay, my time is out. I appreciate the help, and I'm gonna hang out. And I literally and I implore you to get on board and let's open up a dialogue. Stuff me with business cards and get me to the right places. And I think we can do some things that will be ultimately amazing for the medical device, medical technology industry. Thank you.
Thank you, David.